So there's a question that keeps coming in, and that's just how do I, simply answer this question for a client? I've got a prospect. They currently have a low interest rate mortgage. They've paid several years on it, and they're thinking or they're being told that they're better off just to pay extra on that existing mortgage as opposed to refinancing to a lower interest rate today, paying closing costs, and then paying more on their new mortgage. Well, the ultimate real answer there is, well, it depends, right? It depends on the current opportunity to refinance, their closing costs, the interest rates. And what I want to do is show you how easy it is to answer that question. I picked one of the examples that had come in from a loan officer as a question. I've changed the client name. And let's look at the situation. It's very simple to set up. You click the Create New Client Plan button here, and you decide if you want it to be a refinance or whatever, as it would be in this case. And I've already put the case in here just to save us some time. On the Details button, how much extra do they have available for this? The answer is 0. The client wants to roll in all their closing costs and have no out-of-pocket. So the real question is, should they pay extra or should they refinance and then pay extra? The client had $97,000 in income. They were in a 32% tax bracket, a 720 and a 700 credit score. And here's their current mortgage. When we look at the details of their mortgage, they have a property that's worth $285 on a primary residence. They took out $192,000 originally. They've already paid that down to $165. Their current interest rate is 5.875 fixed for 30 years, so a good interest rate. And they're paying $1,135.75 a month principal and interest. We could leave the taxes and insurance out because, heck, they'll be the same either way. Now, here's the real question. This was an important question for the loan officer to ask. The client was trying to decide, should we pay extra? So it sounds like if I could share with you whether or not it made sense to pay extra on your existing mortgage or pay extra on a new mortgage, that's what you want to know. The loan officer asked them what their budget was, and they said they could pay $1,500 a month. That's what they were starting to, and were already paying extra to the tune of $1,500 a month. So what's the difference then between just keeping that current mortgage and paying $1,500 a month or paying $1,500 against a new mortgage? What would make the most sense for this client? And would it pay for them to refinance? Well, it's really easy to explain using the BorrowSmart software. When I go to the Current Liabilities tab, as you can see, it has their current debt, $165,000. You can see they only have 255 months to go on this current mortgage. And they were interested in a new 30-year fixed or a new 15-year fixed. And the loan officer needed to make some money as well as cover some closing costs. So he priced this at 4.875 on the 30 and 4.375 on the 15. That was with no origination, no discount. So you can see just expanded the two programs here that he wanted to make available to that client. I can already see a payment difference here. This payment's lower. This payment's going to be higher. Very easy to set up. I just click 15-year fixed, put in the loan amount. The software automatically bumped the loan amount to cover the estimated closing costs. I have my default set to about $1,700, a little over 1% of the loan amount and closing costs. So it brought in $1,712 and it added that right in. So you'll notice here the net cash is 0 and the net cash at closing from the client is 0. So we took that existing mortgage of $165, we bumped it to $166,712 on both of these. There's no origination or discount points, and we have our closing costs here being covered. So the first question is, would this make sense for the client now from a closing cost standpoint? Absolutely. They've got no out-of-pocket expense here. The closing costs have been rolled in. So that doesn't answer their question, but it at least says, can we cover their closing costs so they have no out-of-pocket? The answer is yes. The second question we want to answer for them is, can they save money here on a monthly basis going to this new scenario? And this is true, right? I mean, I can say $1,136 is your current payment. Your new payment's going to be $882, and that's going to save you $254 per month. Well, that's a savings. But remember what just happened. You just took a 255-month remaining mortgage, and you took it out to 360 months. And this is something that clients are more and more starting to realize, and loan officers are realizing they have to be able to answer this question for their client. Is this really $254 a month in savings? It is on a monthly payment basis, but not if I have to make this payment for another 30 years and I only have to make this payment for another 250 months. If I go with a 15-year fixed, Now my payment stream is shorter. I only have 180 months that I have to make this higher payment of $1,265. So again, I can answer the important question here of which of these payments is going to, or what the payments are going to be and how much I'm going to save on a monthly basis. But how do I answer that really important question of which of these is going to be the best for me if I have a budget of $1,500 a month? Should I keep what I've got now, or should I refinance to one of these two options? And again, that's where this really comes into play here, especially with our new interface. One thing you'll notice here is we've broken out the entire payment now on the borrow screen as well as on the reports. Several of you had said that you thought it would be helpful for the client to see where all of the different numbers were coming from, to see that whole payment. So we've done that for you here. But under this particular example, I first decide on my wealth impact, how do I want to apply my monthly payments? Do I want to use the same payment in every situation using the baseline $1,136 a month across the board? Or in this case, do I want to use a fixed monthly payment of $1,500? So all I do is click fixed monthly payment and I put $1,500, $1,500, and $1,500. And the software now tells you, in this first column here, I'm showing the current mortgage, a 30-year fixed at 5.875 with a payment of $1,500 fixed per month. And remember, that's on the current mortgage balance. So it's taking them from where they are today, and it's saying, if you pay $1,500 a month going forward, this is what the house is going to be worth. This is what your mortgage will be. In this case, I've got it slid here to 13 years, so I'm almost paid off, right? I can see the interest payments, the principal that I'm paying, $161,504. So I've almost paid off that remaining note. And I can see how many months do I have to be debt-free, 159. So I'm looking at their repaying strategy and saying you're 159 months from being debt-free if you just keep your current mortgage and pay $1,500 a month going forward. Now, on this new scenario here, this 30-year fixed, we're going to pay $1,500 a month based on a new 30-year fixed at 4.875% with a $1,500 fixed per month payment. And you'll notice I can go right to the bottom line here, months to debt free. Let me slide that down for you. I can realize here the thing is a little bit low. Months to debt free, 149. So you got 159 here, 149 here. That's going to save the client $17,001 over that remaining mortgage term, which is about 149 months. That's pretty good. That's net of those closing costs, because at closing, okay, I got cash at closing of $1,712, but that all went towards my expenses to pay those closing costs. So the other option was a 15-year fixed at 4.375 with a $1,500 a month fixed payment. And I look down the column and I can see all the numbers. But again, with these numbers, I tend to go right to the bottom line. Let the client ask for clarifying information if they need it. But with a 15-year fixed, the client could be debt-free in 143 months, saving them $25,067 over that same time period. So ask yourself, if you were this client, what would you do? No net out-of-pocket expense, closing costs rolled in. I'm going to spend $1,500 a month in any of these three scenarios, but with this scenario, I'm debt-free in 143 months, and I save $25,067. What would you do? Is there any uncertainty in your mind that this makes the most sense for you? We bring quick clarity, quick confidence for this client. In this case, the client was able to move forward with a 15-year fixed and knew exactly what they were going to save. Now, what I want to do is show you how you might explain that by going through the report with the client. So I just pulled up the PDF of the report for this particular client. Let me kind of slide my recording box right around it. And let's go through and look at the report. So the cover page is straightforward. And then I would go through and I would want to drill into the actual report. And I'd say, you know, you had an objective here. Your objective was to see if you could afford to spend $1,500 a month extra, or $1,500 a month total on your payments. I open up by saying these are your current liabilities now. You owe $165 at 5.875. You're paying $1,136 a month as your required payment. You've started paying $1,500 a month to pay it off sooner. You can keep doing that, have no out-of-pocket expense, etc. But what we've done for you here is we've looked at the three most important considerations. Number one being, does this make sense to you now from a closing cost standpoint? You can see with our new graphs here, we take this key number at the bottom, net cash at closing, and say there is no cash from you or to you at closing. In all three situations, your cash position is remaining the same. That's what you wanted to accomplish. We're rolling these closing costs into your loan amount. You can see we're taking you from a 5.875 to a 4.875 or a 4.375. And now we've got that nice big APR there to make the compliance folks happy. That's like paying 4.965 or 4.529 over the entire term of the loan. So, and I would continue to ask, is this okay? Does that make sense to you? And are you understanding it? Based on this scenario, all you'd have to do is qualify and we would close the loan with no out-of-pocket. Second key consideration would be here, right? The payment. You're currently spending $1,136 a month now, $808 and $328. And I would go through in each of these, let me just kind of blow this up a little bit. I would go through each of these scenarios and say on the 30-year fixed, you've got a property value of $285. Again, we're taking your mortgage rate down by about a point to about 1.5 points. I can see the difference here in relative interest rate. I can see that your new interest payment is $677 and $608. I can see your principal payments $205 and $657 versus $328. And this is just, again, this is using that new simple payment of $1,136 and then comparing it here. Your payment's going to improve by $254 a month. So I can see in my graph, you've got an extra $254 a month if you go with the 30. If you go with the 15, your minimum payment's going to $1,265. So you're going to have to pay an extra $129 a month. So again, I'm able to see and go through and show them how, as we look at this, they have no out-of-pocket expense here, and I can see your required minimum payment difference. So really this comes down to if you're comfortable spending $1,500 a month, I'm guessing that any of these three to you are really the same. What you really care about is the financial impact over time. So let's go to that next page. And I see repaying comparison over 13 years. Why did I slide this to 13 years? Because a client said that they wanted to spend $1,500 a month and see how quickly they could pay off the mortgage. This highlights that. You'll notice in their current mortgage after 13 years, they still owe $3,496. But on the 30 and the 15, I'm showing that they've already hit zero in the 13th year. So if you can spend a fixed monthly payment of $1,500, you'll notice our new report format, how much simpler it is. Repaying comparison over 13 years. I took out property appreciation and tax savings. It's really not necessary. You're going to spend $1,500 a month in each scenario. Here's your house value. Here's your mortgage liabilities, any savings and interest. What is savings and interest balance? What this means is you're already paid off in the 13th year with your mortgage, okay? But you're still making mortgage payments over here on this mortgage of $1,500 a month. To be fair, any extra cash that you have available once the mortgage is paid off, we automatically put into savings. That could be your checking account. So you'll notice here that you'll have $11,793 in this account at the end of 13 years. You have no money in this account and you still owe $3,496. On the 15-year mortgage, you have no mortgage balance at the end of 13 years and you've already got $19,850 built up in your savings account. So you can see the equity difference, $281, $296, and $304. How about interest payments? You're going to spend $72,000 in interest over 13 years here, $55 here, and $47 here. I've got the tax HOMI stuff. I'm not using that. I can see the principal payments I've made. I paid $161 here. I'm still making principal payments, but I paid off both of my other mortgages at this point. I've already paid off the $166,712 that I borrowed. And that extra cash flow, that $11,793 that I had left over, I made that payment to savings because there was no mortgage company to pay off. That's why it shows up here in my savings and interest account. So these are payments that I made, but they're green because they're payments to myself. I've got no expense payments. I've got no cash at closing. Well, I have cash at closing, $1,712, but that's used to pay off my closing costs. I have no rental income. And I can see the total payments, $234, $232, $232. So right here, it's very simple to show the wealth impact to this client. Again, notice how we've just simplified it. We're highlighting that key number. What's the wealth impact? This is my baseline. This is zero. So my equity minus my payments for this client are $281,504. That's my equity. Minus $234 in payments. My equity is $47,504. That's my baseline. With the 30, it's 64,504. That's an extra 17,000. Or if they go with my recommendation, they'll have 72,571, which means they're up by $25,067. And with the little graph here, I can show how many months to be debt-free: 159, 149, and 143. Sorry about that. So you're able to see how simple it is to go through and illustrate these benefits to your client. Then I can go through and bring up my final page here and say, let's look at your proposed liabilities. This is what I'm proposing. 15-year fixed, 166,712, 4.375. Your interest rates are extremely low. You've got one balance, one payment to make, and that's what we're going to handle over the next 15 years. And we're going to show the minimum payment here, and of course, they can make the full payment of $1,500 each month. So that's how it works. It's very, very simple. And for some folks, and again, I've had folks say that they're just pulling out these 3 pages. They'll do the cover page right here, and then they'll cover, and they'll do the closing cost, monthly payment, and annual wealth impact, and they're able to blow their clients away with just those 4 report pages. Hope this helps. If you have any questions or ideas, please send them our way. Have a great day.